Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel. All the comments and subscribers, I greatly appreciate it. This video, we are going to do 5 dividend stocks you can buy today and earn 4 to 8%. The market is absolutely hammered. There are a lot of cash flowing stocks out there whose price has fallen, but they continue to kick out cash flow, therefore yields rise. So let's roll through 5 stocks that you can buy today to make 4 to 8% on your money. Ready? Let's get to work. Number 1, Abbvie, ticker ABBV. Dividend yield, 4%. All right, Abbvie is currently yielding over 4%. You can see the purple line here is the dividend yield. The blue line are the dividends they've actually paid out. And this is 10 years of data. You can see the last 10 years, the blue line has continued to ratchet higher and higher as they've every year kicked out more and more dividend, a higher and higher dividend. The price recently for the stock has come down considerably, which means recently the yield has spiked up. But that's a very nice yield for a stock of a drug manufacturer, and you should definitely check out their ability to continue paying that kind of dividend. If I roll through their revenue and EBITDA to make sure that they can actually afford that dividend, revenue and EBITDA are both growing very nicely. $56.1 or $0.2 billion of top line revenue for the blue bar. EBITDA, which is enterprise level earnings, dividend is paid out of earnings, so we want to make sure they can afford that. They're kicking off $28 billion of earnings for the enterprise last year. The next thing we want to check is debt level. We always want to make sure that if you're paying a high dividend, you're not borrowing money to pay that out. And while it looks like the borrowing money, the blue dollar amounts has grown recently, $68 billion of debt. When we measure that relative to how much they earn, it's not that high. It's 2.4 times earnings, which in our channel, we look for less than 3 times debt to EBITDA as a measure of leverage. This one being 2.4 times checks the box. So for us, good job. They can sustain that dividend. Number 2, British American Tobacco, ticker BTI, yield 8%. Now, British American Tobacco, much like Philip Morris International or other tobacco companies, generally yield higher dividends because growth for them has been slowing. As the cigarette market is shrinking, they've had to rely on price increases to maintain yield and earnings. But nevertheless, they're still around, even though people said tobacco would die off many, many years ago. It's still there, and it's yielding quite nicely. You can see the purple line here is the yield, about 8%. It's been higher than that in the past, but recently it shot up because the market declined. It kicked out last per share of $2.94, almost $3 a share, making it at 8%, a very high dividend yield. Let's see if they can afford it. Revenue has grown over this period of time, over a decade period of time, to $35 billion of top line revenue. Earnings relatively flat the last several years, $16 billion. Now, if you're buying dividend stocks, you're not necessarily looking for the growth in earnings. You just want to make sure they can sustain the dividend payment. Next thing we want to do is check debt. Debt levels for this company are about where we want to see as the maximum. 3.4 times debt to EBITDA means they're fairly leveraged. I like seeing the debt number come down, fall as they buy down debt from $57 billion to more recently $49 billion. That puts them basically at a 3x at the end of the fiscal year, which is right on the money for us of 3 times debt to EBITDA. So I think they can continue to afford the debt. And if you're buying for the income, this is a high yielding stock that should last for a long time. Number 3, Gilead Sciences, ticker GILD, dividend yield of 5%. All right, this company is another drug manufacturer. Let's take a look at where they are. So 4.6% dividend yield currently. You can see the yield climbing over time, actually really very nicely over this 10-year period of time as the dividends themselves have been growing. The blue line is the dividend that's paid out. Most recent, $2.92 was paid out. If you annualize that, put that against the share price currently, that's a 4.6% dividend. And I like to see the dividends grow consistently, and actually the dividend yield is growing consistently. That's very nice for income investors. Revenue and earnings for them have been a little up and down. Obviously, it's a drug maker, so as drugs go to generic, they fall out of the P&L, so you have to always keep that ball rolling for the drug manufacturers. But over time, it is both largely profitable and growing, aside from here, but they've been growing recently. $27 billion in total revenue with earnings of $13 billion. They can afford the dividend. They are growing. And if you're buying it for the income, this seems like it should be able to be maintained. On the leverage basis, the blue line is the total leverage. It's tough to see here because it's all stacked on top of each other, but that's an $18 billion leverage, so it's total debt number, which is only 1.3 times debt to EBITDA. So they can afford the leverage, they can afford the dividend. They're growing recently, and they're paying a good yield. It seems like a solid company. Hey, sorry to interrupt. If you like the content, please subscribe. I greatly appreciate it. Also, if you want more stock tips, check my website out, cashflowinvestingpro.com, where I produce one-pagers like this one, summarizing 10 years of financial information for American Express. I give you a forecast of what I think it's going to do, and currently, I think it's yield 23% IRR for the next decade. An amazing stock pick. There's lots more. Check out the link below for a free one-pager at cashflowinvestingpro.com. Number 4, 3M. Ticker MMM, dividend yield 5.5%. Now, 3M has been in the headlines recently for some legal issues that are coming through for some products that they sold. And as a result, the share price is down substantially. But if we look past that long term, we might be able to find a very high yielding stock that's of quality. And you can see they've been raising their dividend historically pretty nicely over this period of time, a little flat-ish the last several years. But the dividend yield itself, the purple line, is up to an all-time high, almost 6% dividend yield, which is in the 10-year history, it has not been that high, which to me seems to be an interesting opportunity to maybe put your toe in the water on a stock that has a little bit of risk, but would give you a very strong yield historically, higher than it's ever yielded. On revenue grows pretty steadily for this business, revenue and earnings. It's like a low single-digit kind of company that plots along, but seems to be able to kick out cash regularly. $35 billion of top-line revenue, $9.7 billion of EBITDA, that's enterprise-level earnings. Again, slow growth, but profitable every single year. On the leverage side, they have $13 billion of total leverage. That's the blue line, $13.5 billion. When we compare that to their earnings, the EBITDA, it's only 1.3 times earnings. So they can afford the dividend. They are growing. Aside from the legal issue, which I will caveat, seems like a very attractive risk-reward basis for a high-yielding dividend stock. Number 5, Crown Castle, ticker CCI. Dividend yield 4.4%. Crown Castle owns the cellular network infrastructure across the United States. The actual cell towers that relink cell network infrastructure, those towers are owned by this company. And it's a leveraged play. They finance that infrastructure heavily and expand by the spread between what they can charge their customers for the use of that tower versus the leverage rate versus the interest rate that they borrow to build those towers. And you're going to see what I talk about, what I mean in a second. The dividend for them have been growing for the last decade very, very steadily. It's generally a very high dividend-focused type of company, and they pay $5.88 last dividend, giving their yield about 4.4%. As the stock falls, you're seeing the dividend spike rise. It has not been that high for almost 5 years ago. 5 years ago, it seems like a very interesting, attractive play. Let's keep going. Revenue and earnings are absolutely growing. They've continued to be able to use leverage to expand their per unit holdings across the United States, and each individual cell tower that they add adds cash flow to the business, so revenue and earnings are growing. Most recently, $6.3 billion of top-line earnings and $3.6 billion of EBITDA. We like both those numbers. Here's where it gets sticky, the leverage. Because they're an asset play, what they own is a cell tower, they are able to finance that, and the banks are willing to lend them lots of money to do so, and historically it has really worked for them. Currently have $26 billion of debt outstanding to finance all the equipment that they own. That's a leverage ratio of 6.4 times. So for us at the channel, it is above the metrics, but this video is specifically catered to dividends. So I wanted to weigh the fact that they've been able to grow historically very, very nicely. It has a nice dividend yield of above 4%, but it's leveraged. So I want to throw that as a cautionary tale out there. It's a very interesting company that should be able to weather the storm, given the cash flow and given the need for the infrastructure that they own. Okay, so that's a quick look at 5 stocks that pay strong dividend yields that you can consider during this down market to earn an income of maybe 4 to 8% over the long term, and that dividend income should grow over time as those businesses continue to perform. If you liked what you saw, I highly encourage you to check out my website, cashflowinvestingpro.com. In here, I do 2 things. 1, I teach an investment course that teaches you to be an analyst and dig deeper into the stocks that we just reviewed, building out a forecast model, showing you how to make a portfolio of 20 to 30 stocks that you can own for the next 10, 20, 30 years. To really ground your wealth and build it over time. That's how true wealth is made, not by trading stocks. Check out that course. One course would teach you enough for a lifetime. Other thing I do is I have a cash flow club where I make one-pagers on stocks summarizing 10 years of revenue, earnings, cash flow, debt levels, and most importantly, price ratio, how much you pay for those earnings. I also build forecasts and give out a guidance on a particular stock. This we do at the channel multiple times in a month, 10, 15 different stocks, far more than I can review on this channel. Check it out. It's a subscription club, but there's a lot of value in there, and people have really, really enjoyed it recently. Thank you very much for the time. Up's going to pop a couple of videos where I have done deep dives on individual stocks to teach you how to be a fundamental analyst, how to buy cash flow. This market right now, because it is falling and it will continue to fall, is presenting very attractive options for companies that are off the beaten path, that have low debt, that make tons of cash flow and treat the owners, the stock owners, like true equity owners and not sources of capital like a lot of the tech companies have in the last 10 years. So we focus the channel, we focus on the club, finding stocks that are yielding very, very strong cash flow, that are underpriced, and we think will beat the market over the next decade. We have recently posted several stocks that are estimated to yield 10, 20, 30% annual IRRs for 10 years. Really strong companies. I highly encourage you to check out the website, cashflowinvestingpro.com. Up is going to pop a couple of videos. Take a look at the deep dives. Thank you. Bye-bye.